Welcome to Chetana World. Today we are going to awaken our minds with knowledge of gold ETFs. How to buy, where to buy, is it safe or not? Let's watch for more details.
Financial advisors consistently recommend keeping 10 to 15% of your total investment portfolio in gold. It acts as a reliable shield when markets get volatile and helps your capital keep pace with inflation. For generations, the default response to that advice has been to buy physical gold for festivals and weddings. But holding the actual metal introduces immediate financial friction. You pay upfront GST, absorb steep making charges, and take on the recurring costs of bank locker fees and theft insurance. These are active expenses that quietly bleed away your actual return on investment year after year. Today, the financial system allows you to separate the price appreciation of the metal from the physical burden of storing it. You now have 3 distinct digital pathways to capture the upside: gold ETFs, electronic gold receipts, and multi-asset funds. The challenge is no longer how to buy digital gold, but matching the specific digital asset to your actual timeline and real-world goals. Let's start with gold exchange-traded funds, or ETFs. This is the most established entry point for digital gold investing. You buy and sell ETF units directly through your standard DMAT account during regular stock market hours, exactly like trading shares. The barrier to entry is extremely low. You can start investing with the equivalent of just 1 gram, or even 0.01 grams in some cases. Behind the scenes, asset management companies take your digital investment and store the exact equivalent in 99.5% pure physical gold inside highly secure vaults. You never worry about purity or theft. If you sell your units within 12 months, the profits are taxed according to your standard income slab. Hold them for over a year, and that shifts to a long-term capital gains tax of 12.5%. But there is a strict limitation. When you sell an ETF, your bank account receives cash. You cannot claim the actual metal. If your goal is pure financial return and fast liquidity, ETFs are highly efficient. If you are investing to eventually hand over jewelry at a family event, this instrument will fail you. That leads to a newer option, regulated by SEBI and traded on the National Stock Exchange: electronic gold receipts, or EGRs. The architecture here is different. Approved banks and bullion dealers deposit actual gold into recognized vaults. They then issue a digital receipt against that exact physical deposit. You can trade these receipts from 9 a.m. all the way to 11:30 p.m. That extended window lets you react to international price movements happening late in the evening. You can buy amounts as small as 100 milligrams or scale up to a full kilogram, choosing between 999 and 995 purity standards. The defining feature of an EGR is direct ownership. At any point, you can surrender your digital receipt and actually take delivery of the physical gold to your home. Because you are buying a digital receipt today, you pay 0 GST up front. The taxes and nominal vaulting charges are only triggered at the exact moment you decide to convert that receipt into the physical metal. EGRs solve a major logistical headache. You lock in the price of gold for a future need today, without paying years of storage fees and early taxes in the meantime. The third path is multi-asset allocation funds. Here, gold acts as a protective shield within a broader strategy. Instead of you buying gold directly, professional fund managers dynamically shift a pool of capital across equities, debt bonds, and gold based on shifting market conditions. Data shows this approach can offer superior risk-adjusted returns. A study by White Oak Capital analyzed over 2 decades of market performance to prove this point. A portfolio of 100% debt yielded an average return of 6.83%, carrying a specific risk level. By shifting to 55% debt, 25% equity, and 20% gold, the historical return climbed to 11.61%, while overall risk actually dropped. The trade-off here is control. You are handing the steering wheel to a manager, which means they might drop the gold allocation below 15% if they spot better opportunities in other sectors. This is the ideal vehicle if you want the mathematical, defensive benefits of gold, but refuse to do the manual chore of rebalancing your portfolio. You can ignore the financial jargon. The right choice depends entirely on your ultimate life goal. Consider the future planner. This is someone who knows they will need physical gold in 5 to 10 years for a wedding or cultural event. This chart shows exactly where they should go: electronic gold receipts. They lock in today's price while completely deferring storage risks and taxes until the day they need the metal. Next is the pure optimizer. This investor only cares about gold as an inflation hedge and demands instant cash liquidity during emergencies. For them, gold ETFs are the direct path. They get the price appreciation with zero physical drag and can sell for cash instantly. Finally, we have the hands-off investor. They want the protective shield of gold without the mental bandwidth of managing it. Their capital belongs in multi-asset allocation funds, where the balancing act happens automatically in the background. Never buy a physical asset to solve a financial problem. By matching your real-world timeline to the correct digital instrument, you capture all the wealth of gold without